Outside observers have a number of concerns about China. One is the state-controlled banking system. They're worried about the rise of informal financial dealings known as shadow banking and the risks it poses to the national economy. Chinese leaders seem to be listening. Last month, they announced steps to give lenders more freedom to set interest rates. Experts are watching to see if this could be a step toward a more market-based financial system. Unlike many other countries, the interest rates offered by commercial banks in China are set by the government, not by the market. Officials at the central bank set the benchmark rate and also the limits on loans and deposits that banks can offer. The goal is to make sure banks earn risk-free profits. This system encourages big banks to make loans to well-connected, big state-run companies in the belief the government will always back them. These financial rules fueled decades of economic growth. But they also meant that banks had no incentive to compete with each other by offering more attractive interest rates to customers. This situation put small and medium-sized companies in a bind. Many of them were shut out of the official financial system. So, in their search for credit, they turned to non-bank entities that offer services such as money management and loans. The interest rates charged on loans by these shadow banks tend to be about 20%. We spoke to Kelvin Lau, a senior economist at Standard Chartered Bank in Hong Kong, on what impact the new rules might have on the financial system.
China's own financial market right now is being governed by a lot of policies, and that includes interest rate setting mechanism as well. So the traditional problem of this kind of financial system is that because the policy makers set the interest rates for the banks, and hence the cost of borrowing for the whole economy as well, that has led to some side effects, including, say, the inefficient sort of allocation of resources. So you can imagine that by setting artificially, say, setting interest rates too low or too high, that could influence banks' behavior. And that could end up, in China's case, for example, an over sort of lending to some of the better quality and government backing companies, state-owned enterprises. So that hence spurred the growth of the shadow banking or the informal banking system. So the idea behind interest rate liberalization is try to sort of replace sort of policy-driven interest rate setting mechanism with a more market-driven mechanism to ensure better allocation of resources.
Chinese authorities unveiled a set of reform measures late last month. They removed the limits on interest rates that banks can charge to borrowers. The current benchmark rate for a one-year loan is 6%. Under the old rules, that means the lowest interest rate a bank could charge for loans was 4.2%, 70% of the base rate. Now, with the floor removed, banks can charge as low a rate as they want. But the central bankers did not change the rules on interest rates for deposits. The current one-year rate is 3%. Banks can't offer depositors interest rates higher than 3.3%, 1.1 times the benchmark rate. The spread guarantees that banks make money on loans and deposits. Now let's look at how these policy changes are working in the real world. The goal of the new rule was to spur lending to small and medium-sized companies and to reduce shadow banking activities. Banks are now free to try and attract more business by offering lower interest rates. But according to central bank officials, 90% of loans are still being made at or just above the benchmark rate. One reason for this may be other restrictions that are still in place. Authorities limit the total value of loans a bank can make. This means that banks still have no incentive to offer cheaper loans to their customers.
Chinese banks needs to see more liberalization to complete the whole interest rate liberalization process, because right now, if you only create more flexibility on the lending side, but without giving them the same flexibility towards the way of gathering deposits and controlling the cost of funds, then it will be difficult for them to completely transform themselves to embrace market forces. So I think, I think it's a matter of time, but then eventually those that are currently being underserved will gradually benefit.
Many economists agree with Lau. They say Chinese authorities should free up banks to set their own interest rates on deposits based on market forces. This would enable them to compete with the shadow banking system. But many big banks oppose these steps to liberalize the industry. The reforms threaten the system of guaranteed profits they've enjoyed for years. Another obstacle to reform is the lack of a safety net for depositors. Chinese authorities have yet to introduce any type of deposit insurance scheme. Lau says such a move is necessary for any real reform to take place.
By allowing banks to compete on setting deposit rates, that could potentially lead to exuberances or sometimes sort of excessive sort of behavior, and therefore, in order to continue to encourage people to place deposits with banks, and also to safeguard banks themselves from overdoing things, I think having a deposit sort of insurance scheme in place will certainly sort of help maintain the sentiment and also give the confidence. And I think it's a very, very important step.
Analysts around the world are waiting to see if the reforms will help diminish the shadow banking system, but Lau believes they'll continue to thrive.
I think shadow banking sector still has a need to serve, and that is to fill the gap to meet the needs of those that are currently the formal banking sector is not willing or is unable to fully satisfy. So that is still a role that they will continue to play. Over the medium to long term, I think there will certainly be a bit of a substitution effect happening. So as the banks becoming more competitive, both in terms of lending as well as in terms of deposit rates, hopefully more policy liberalisation will come on the deposit side as well, and that will sort of remove some of the reliance on the shadow banking sector. Shadow banking sector is not an evil thing per se. It's just it still has a role to serve. So we continue to see a parallel sort of expansion in both sides.
Well, the reform process is still at an early stage. A critical issue for Chinese leaders will be how fast to proceed. Too fast and there's a risk of destabilizing banks, but too slow is equally dangerous. Analysts say China needs a freer financial system to ensure the economy keeps growing.